Hello, in this lecture we're going to continue on with our discussion of describing supply and demand elasticity, chapter 6. Remember, our goals are to use elasticity to describe the responsiveness of quantities to changes in price and distinguish 5 elasticity terms, explain the importance of substitution and determining elasticity of supply and demand, relate price elasticity of demand to total revenue, and define and calculate income elasticity and cross-price elasticity of demand, and finally explain how the concept of elasticity makes supply and demand analysis more useful. So elasticity of demand and market demand. So price discrimination occurs when a firm separates the people with less elastic demand from those with more elastic demand. So if we think about some application of these principles, we know that the market, people within the market are going to have different elasticity curves for themselves. So if we think about the people consuming our products, if we were somehow able to separate different people in terms of how elastic the product is to different individuals, then we could specialize our price. We could try to change our price in such a way that we can aim at these different individuals and maximize our price by having different prices depending on the level of elasticity to different markets. So if we had, for example, different areas of the country or something like that, and we were selling the same amount of good and the two areas of the country had different desires or different elasticities, then if the firm could have an incentive to try to change the price depending on where they are distributing the goods. So firms that price discriminate charge more to individuals with inelastic demand and less to individuals with elastic demand. And that, of course, just makes sense because an inelastic demand means that people are more willing to pay a higher price, and therefore the firms would want to charge a higher price to those individuals. And people with elastic, then they're more price sensitive, and therefore firms would have to lower the price in order to generate more revenue. Income and cross-price elasticity. So we can apply this same concept of elasticity to other types of areas. We're going to first start with income. So income elasticity of demand measures the responsiveness of demand to a change in income. So we're talking about individuals' income increasing or decreasing, and we're going to compare then, same type of analysis, the change in demand compared to, in this case, the change in income. People's income changes, what's going to be the effect on demand. So if we think about that, then we can say, well, normal goods are those whose consumption increases with an increase in income. So normally, if someone's income goes up, they're usually going to want to buy more of a particular good. But that might not be the case for all goods. There are some goods that we're going to call inferior goods, and those are whose consumption decreases as someone's income rises. So if we were having our increase go up, most of the time, most of the goods we have, our consumption will go up. We'll say, okay, I'm going to buy more of this particular thing. Most goods out there, that's the way they are. So let's think about the exception to the rule, and that would be the inferior goods. So an inferior good would be something that when our income goes up, we're going to buy less of it. So if we think about like food or something like that, we're going to think of if we buy like top ramen or something that's a fairly cheap type of meal, then as we get more income, we might buy less of that. We might move away from that type of meal to something that would be more expensive. Another example would be like if we're buying, Spam or something like that, we might move away to something else as our income rises. So as our income grows up, we might buy actually less of the top ramen and whatnot and move and shift our consumption to something else. So income and cross-price elasticity. Cross-price elasticity of demand measures the responsiveness of demand to changes in prices of other goods. So now we're going to compare the change in our demand to the change in price of a related good. So we're talking about some other good and the consequence of that on our demand of our good. So substitutes are goods that can be used in place of another one. So a substitute would be something that can replace our goods. So if we talk about the hamburger shop, then if someone is next door selling hamburgers or selling something related to hamburgers, then there's a substitution effect in that if the next door neighbor changes the price, then that will have an effect on us, meaning that if the substituted item increases their price, then people are probably going to come to us instead of going to them because we have the same price. If, on the other hand, the person next door with the substitute decreases their price, then that will decrease the demand for our product most likely. And then we can think about complements. Complements are going to be things that go together. So if we sold, say, the hamburger and fries separate, and then we changed the price on the hamburgers or the fries, so if we sold hamburgers and we lowered the price of the hamburger, then we might sell more fries too, because people often buy them together. If we did the same thing if we increased the price of the hamburger, then consequently we might sell less fries as well, because the two things go together and people might buy the less of the hamburger.